are able to attend this. I'm going to be talking about sales tax and use tax, and do my best to give you information and try to get your questions answered if you have them. I'm going to do my best to give you good information, but whatever I tell you today is not binding, which I know that ought to give you a lot of confidence on everything I'll tell you. It's not just me, it's every representative of the Department of Revenue. Basically, what that kind of means is they're not going to really know exactly everything you're doing, what is taxable, until they audit you. But that doesn't really help you in a situation where you're selling. So what the law says is, well, you can write it and get something called a private letter ruling. Now, first criteria is you must be registered, which means you must have a sales tax number. So they call it a sales tax registration. So when you register, you get a sales tax registration number. And they've probably sent you a certificate that has that on there. A lot of people think that's an exemption certificate. Well, no, that's your sales tax number that you provide on certificates and things like that. But I'll go over that. But you have to, this private letter ruling is binding to whoever writes in for it. Now, I don't know if you guys had access, but the main book for sales tax is this Kansas Sales and Compensating Use Tax. It's a KS 1510, and it's KS-1510 if you're looking for it on the Department of Revenue website in the search field. You have to put that dash in there because the website doesn't understand if you just put KS-1510. It doesn't quite understand, but if you put in the KS-1510, it'll pull up a PDF and it'll pull this up. It's basic sales tax. It's basically trying to cover almost every industry, so it's sort of generic in nature. So that's why it doesn't necessarily answer every single question that you probably have. It answers generically what the laws are, but it will answer quite a few questions, some basic questions anyway. But in that book, there's a section in there that talks about the private letter rulings, at least how to get one, and it's on or about page 28, depending on what version of this book you have. I update these books, so the ones I provide for the Small Business Development Center sometimes have a few more updates than the ones online, just because I haven't been able to update the ones that I can provide online yet. I'm the only one in the state that does this, so a lot of times I'm out on the road. Normally I'm out on the road, now I'm doing this, but so I'm not able to be both places. But with that said, in the book I have on page 28, it's under the revenue notices and private letter rulings. And there's a section there that talks about what a private letter ruling is, and if you were to email for that, and you would send an email to the email address is the general email, which is KDOR_TAC@ks.gov. And then you would put in the subject line request for private letter ruling, and then it'd be attention to policy and research. What a private letter ruling is you must be something that actually is happening. It cannot be hypothetical, because it is binding, and it needs to be, they're only going to answer what you ask. So if you ask this much of a question, they're going to give you that much of an answer. So you need to ask, be as specific, and provide as much information as possible. A lot of times pictures help. Now, I don't want to offend anybody, but hand-drawn pictures don't always help. We've had some that the people just were not artists, bless their heart. If you can take an actual picture of whatever it is you're talking about, this is what's attached to the ground. This is simply because that shows us what okay, that's what you meant by that. And then we can make that determination, based on what the law says, or the regulation, or if there's an appeal case, Supreme Court case that ruled on that. then they can give you a letter that says, yes, this is taxable, or no, that's exempt because this. And so you put that in your file. And so if you have a letter that says, hey, what it is you wrote in for was exempt, if you get audited and they said, well, that's taxable, you can show them this letter and that's your get out of jail free card. And it's exempt and it's binding to you and only you because it's based on your set of circumstances. It's free to write in for those. A lot of people just do not know that those were even an option available. There's also notices that we put out on our website. Typically that happens after the legislative session gets out. That's usually around May or June, somewhere in there, that we'll have. And we've already got one out there about the extension of the income tax due date, but it's basically based. A lot of those are on changes in the tax laws, and we'll have notices that go out there that says, hey, this is what happened, and this is what you need to do, or this is how we interpret it, and how you handle that on a return of some kind, or how that'll affect this industry, things like that. In Kansas, the sales tax, it's kind of interesting. Every state's different, but in Kansas, our laws in layman's terms basically says for the privilege of doing business in Kansas, you must register, collect, and remit sales tax. What that basically means is the default is when you sell a physical item, it's taxable. So that's the default. Everything's taxable. So if an auditor comes out, he's looking at everything as being taxable. So the burden of proof that something is not taxable is on the seller. So you as the business. So what you're going to be doing is keeping your records to show that, hey, I have collected sales tax on everything I sold, or I have something in my records to show a good reason why I did not. And so that's what we're going to show you here. Also, the whole thing is for the end user to pay the sales tax, which I'm going to go over that as well. Now, see here in Kansas, I don't know if you guys know that sales tax has been around this long, but it's been around since 1937 in our state. It's actually a tax that's been around much longer than this. It's been around for eons, but it's the most popular tax because it's basically based on what you're using. But in Kansas, this happened back in 1937, and in the United States, this is about the time frame when states started imposing this in the Great Depression, because at that time, the incomes went down. Well, if they were relying on income tax, their revenue went down, so they had to find another revenue stream, and now they had sales tax. A question I get a lot of time is, well, if people were broke and didn't have money, how did they think they were going to get money from sales tax? Well, what people need to realize is sales tax is, yeah, it's on when I purchase something, but it's also barter and trade. And that's the way it's written at the very beginning. It's basically, they say words like it's any consideration, any valuation of whatever it is. So in other words, if I were to trade something, you and I were to trade, I would have to come up with a market value of this, and you'd have to come up with a market value of that, and we'd owe sales tax on that, both of us. It's been that way since 1937. So I have told people this before, and boy, they got mad at me. I'm like, it's been that. Get mad at those guys back then, and you can get mad at those, but really they copied that because we weren't the first state to have this. So we're not the original state for that. So also, you may not realize how you paid sales tax back in 1937. States paid it with a token, a mill coin. Kansas, we had 1 mill coin. It was a 2 mill coin. We only had one token, which is a 2 mill coin. Mill means a fraction of, so basically it was the sales tax on a dime. In 1937, you could actually buy things for a dime, but businesses would not give money for those tokens because people would have to go buy these, but they're not going to give change for it. So if it ever ended up where there was too much sales tax, a person ended up paying too much sales tax. So there was an emergency legislative session, and they enacted a law where they created a 1 mil token in addition to a 2 mil token so that they could get changed, that type of thing. And they put a hole in it so you could tell it apart. The whole system was really doomed because it lasted about 18 months. Everybody hated this system. So we were the first state. Kansas was the first state that collected sales tax as a percentage of the sales. So we were it, and it's stuck. That every state does that now. So little old Kansas is the ones that did that. We were the trendsetters. So now you can dazzle your friends with that useless trivia. So just tell people, hey, did you know this? You might remember that out of everything I tell you today. But when sales tax started back in 1937, it was 2%. It was only state sales tax. So right now, the state sales tax rate is 6.5%. And it's been that since 2015. So it has, the state sales tax rate hasn't changed since 2015. So I don't know if it'll change. I don't think it's changing this year, but in the 1970s, they had a law where they said, well, the local jurisdictions, cities and counties, have the ability to impose a sales tax. So most cities and counties do impose a sales tax. There's a few that still don't. So the cities and counties can impose a sales tax. Also, within cities and counties, there can be special jurisdictions. Some of them are called community improvement districts, transportation development districts, star bond district, different things like this. It's an isolated area. It's another jurisdiction. As a business, you're required to collect the combined rate of sales tax. So the combined rate of sales tax is all of these put together. You send it all into the Department of Revenue on your sales tax return, and we distribute it. The Department of Revenue distributes it. You don't do that. Thank goodness that's the way it's done. There are some states that require a sales tax return for each jurisdiction. We don't do that. We require one return, and it's filed on one return. And most states do it that way, by the way. So right now, the state sales tax rate is 6.5%, and then each city and county has different sales tax that they have imposed. And then there's isolated areas. Now, these community improvement districts are all over the place. I don't think anybody's immune from them. I've seen them out in western Kansas, places you wouldn't think they'd be. I'm in Topeka right now, and there's if you go out to Wanamaker Road, that's a pretty popular road in Topeka. There's an Academy Sports out there, and you go out there, that's a community improvement district. It's an extra 1%. So the sales tax rate in Topeka is 9.15%. But if you go over to that shopping center where Academy Sports is, it's an extra 1%. So you'll pay 10.15%. It's the same there. We got a fairly new Popeyes chicken as well. That's a community improvement district where you're going to pay an extra 1% there. So, but they're all over the place. So like I said, no place is immune to them. It's a way to develop, apparently. So if I was live, I'd be asking you guys if you had to guess where the highest combined rate of sales tax is, where you think it is. And most people think Johnson County, and it's not. And it is the highest rates, by the way, are in a community improvement district. So the highest rate right now is in Ottawa, Kansas. It's 11.6%. And it's a Holiday Inn Express, so it's a hotel. And then you got a tie for second place, which is Junction City, Leavenworth, Coffeyville, and Chanute, 11.5%. And these are all community improvement districts. So the majority of them are hotels, and typically a hotel or a shopping center. So hotels also have the ability to impose, so not hotels, cities and counties have the ability to impose something called transient guest tax. That's what hotels charge if you stay there. So if you've ever stayed at a hotel, you never see transient guest tax. It's usually called occupancy tax or guest tax or something along those lines. They never call it transient, though. I guess that doesn't sound good, but in Kansas, it's called transient guest tax. It's in addition to sales tax. So there could be, I believe it's in Ottawa, it could be an extra 5% or so on top of that 11.6. But kind of shows you that people kind of don't pay attention to sales tax. They just kind of blindly pay it. And in fact, a lot of people don't realize what they're paying in sales tax until they make a large purchase, like an automobile, and then they see it because what's that large dollar amount? And the car dealer, well, that's your sales tax. And it's like, well, let me throw that into financing. I'll go ahead and pay some interest on that. But as a business, you're going to start paying attention to this, because the whole idea is you are going to be collecting that and passing it on to the Department of Revenue. That's what it's supposed to be. That's kind of why they used to use tokens, because there's like, you're collecting that and passing it on, and it's not you. They didn't want it to, they were trying to make it so that it didn't feel like you were paying it, you were collecting and passing it on. That's what they were trying to say. They call it a trust tax as well, meaning they're trusting you to collect the tax. If you noticed when I said it was a privilege, that means you're doing everything, we're doing nothing, but you're required to collect this tax for us, Department of Revenue, for the state of Kansas, and send it into us. And they're trusting you to hold the state's money until it's your time to send it in. Well, what is the sales tax imposed on? Well, the statute for this, when you see KSA, that's Kansas Statutes Annotated. 793603, that's the imposition of sales tax. Number one thing is tangible personal property. They have definitions. They have to define certain words in statute, because what they call it in statute, the rest of the world might have different definitions. So they have to make sure, well, this is what we mean by that. So the definitions for the sales tax is in statute 793602. And so they define a tangible personal property, of which I wrote it down there. It means property that can be seen, weighed, measured, felt, or touched, or any way perceptible to the senses. So it's a physical item. What's interesting, though, is they can also define something as tangible personal property, which they did. So they said, hey, we're going to call electricity, water, gas, steam, and pre-written computer software. We're going to define those things as tangible personal property as well. So if we define those particular things as tangible personal property, we're able to tax those things when sold. So if you sell a physical item, you're required to collect sales tax on it. That's the default. That's the general rule. So you'll have the general rule of law, and then you'll have the exceptions to the law, and of course, then you'll have the exceptions to the exceptions. Now, if you sell a physical item, tangible personal property, and the end user, typically the end user is your customer most of the time, but not always. But if you sell to the end user, and the end user takes delivery of that item you sold outside of the state of Kansas, you're not going to collect Kansas sales tax. Simply because Kansas can only enforce Kansas laws in Kansas. Our laws are no good in any other state, and no other state can enforce their laws in Kansas. So let's say you sell something and you have it shipped via UPS or something. Well, you need to keep something in your records to show, heaven forbid you're ever audited, why you didn't collect Kansas sales tax. Oh, well, they took delivery of it outside of the state. Well, that's a good reason, right? No problem. No problem. Well, the question I usually get at this point is, well, and usually people are in a panic. Well, do I need to collect their tax? Do I need to collect that state's tax? And here's the answer to most sales tax questions. And people do not like this answer, but it is the truth. It is the answer to most sales tax question is it depends. Nobody likes that answer. I don't like that answer, but that's the truth. It does depend. It used to be if you didn't have a physical presence there, which still, if you do not have a physical presence there, meaning you do not own or rent real estate, you do not have a employee or a representative in that state furthering your business, representing your business, acting on your business behalf, or you do not deliver what you're selling with your own vehicles, your own company vehicles, or your own personal vehicles. If you use third-party carrier, meaning United States Post Office, UPS, FedEx, that type of thing, that's not a nexus. That's not a nexus, meaning a presence, a physical presence, a sufficient presence. A sufficient presence means what they mean by that is it's sufficient enough that any sale into that state, a state can require a business to collect that state's sales tax. But if you have a physical presence in that state, you absolutely will need to contact that state, because that state more than likely is going to require you to collect their sales tax. So that the rule of law has always been, at least since 1992, that was based on a Supreme Court case, Quill versus the state of North Dakota. Physical presence is the criteria, and which I told you, the owner rent real estate, deliver with your own vehicle, or have a representative in the state. Well, the world changed in 2018, June of 2018, and I don't know if you've heard of Wayfair versus the state of South Dakota. Something called an economic nexus. Economic nexus meaning a dollar amount sold into a state. No physical presence at all. I sell a certain dollar amount into that state. Or I sell a certain number of times into that state. This is what South Dakota said. They changed their laws. Here's why, because people, I'll go over it later, because people are actually supposed to pay compensating use tax when they don't, when they didn't pay any sales tax on something, which I'll go over later. But just know that people haven't been paying it, even though they were supposed to. So states have lost all this money, and that was one of their arguments with the Supreme Court was, states have lost billions of dollars over this since '92, and so what we want to do is capture at least some of this revenue. So what South Dakota said is, well, if a business sells into our state and their sales are $100,000 in a calendar year, or they sell 200 times in a calendar year, we're going to require them to start collecting our sales tax from that point forward. Not retroactive, but from that point forward. Well, that's what passed the Supreme Court. That became the rule of law at that point. And so all the states follow suit. And Kansas, now Kansas doesn't, that threshold, that $100,000 and that 200 times, not every state has the same dollar amounts or number of times. Kansas does not have that threshold. First dollar an out-of-state business sells into our state, we require them to collect sales tax based on our law, which in the legislature right now, there's a proposal to put a $100,000 threshold. But some states actually have more than that. They'll say, well, if it's $300,000, so make it higher. But basically, they're trying to, what they call, put a safe harbor for small businesses. But if you're a small business, if you sell into that state and you don't sell more than $100,000 in a year, or you don't sell more than 200 times in a year, and you don't have that physical presence, then you will not be required to collect their sales tax. You didn't do anything that requires you to collect their sales tax. And then if you had it delivered by a third-party carrier, you don't have a presence in that state, you wouldn't have to collect Kansas sales tax on that sale because it was delivered outside of the state. So I get that question right there. That's why I bring that up there. Let's see here. Okay, services. One thing I get questions about all the time, I have people say, well, services aren't taxable. Well, there are services that are taxable. There's in our law, we have what they call an imposition for taxable services. So if it's written in our law that this is taxable, there can be a taxable service. So one of the main things, what I want you to notice is when they defined tangible personal property as being taxable, they kind of used a broad paintbrush, because if you tax a physical item, that's a lot of things. That defines quite a few things. They kind of did that with services as well. They used a broad paintbrush. They said, well, if you repair, service, alter, or maintain tangible personal property, that's a taxable service. Well, that covers quite a few things. Doing that to anything that's tangible. So that's auto mechanics, computer repair, clothing alterations, anything, if you're altering any kind of tangible personal property, if you're maintaining any tangible personal property. So this is why all the time I'll have people that'll maybe do something to clothing, and they'll say, well, all I did was I sewed a button on. I sewed a new button on, or I sewed a patch on, and it's like, well, did you alter or maintain or repair? Yeah, you did. So shirt is tangible personal property, so that is a taxable service. Now, if you repair, service, alter, or maintain tangible personal property, that is a taxable service. But things like getting a haircut is not taxable because you're altering or maintaining a human being. So that's not a taxable service. Or a massage is not a taxable service. One thing that's interesting, though, is animals are considered to be, like dogs, they're tangible personal property. So when you go to the dog groomer, that is a taxable service because you're altering or maintaining tangible personal property. And usually I'll have somebody moan or yell at me because they'll say, well, Fluffy's part of the family. And I don't disagree, but just got to pay sales tax when you take to the dog groomer. I have a whole different class for construction contractors because they have a much more difficult task in collecting sales tax. Their laws are more difficult than regular retail sales like this class. They install or apply tangible personal property into real property, into real estate. So that's where it's different, is they're working on real property. So buildings and stuff that's affixed to the land. So that's where the laws changes if they're working on real estate. So a lot of times I'll have auto mechanics get confused with contractors because they use some of the same terminology. They'll say, well, we have parts and labor. Contractors have materials and labor. Well, an auto mechanic's working on tangible personal property, a motor vehicle, a car. Contractor's working on a house or a building or on the land. So that's the difference. So an auto mechanic's in this class, he's retail sales tax. Thank goodness for the auto mechanic because this is easier. Contractors, much more difficult. If you're a construction contractor, if you were, be thankful you're not a construction contractor because sales tax is twice as hard as this. One of the services, in the service category, they say if you are selling something, admissions to something that's providing amusement, entertainment, recreation, that's taxable. So if you're selling admissions to theater tickets, to carnivals, to even the state fair, it could be school plays, that's taxable because you're providing amusement, entertainment, or recreation. Now, admissions to places that provide amusement, entertainment, recreation. So if you go to a place that's teaching, there's no imposition of the law for teaching, meaning that teaching is not taxable. Consulting is not taxable. There are some professional services that people call professional. Not all of them are necessarily considered professional. On page 5 in that book, I just put a small list of services that people typically consider not taxable. There might be exceptions to this, but some of these services, they're not taxable, like accounting services are not taxable, architecture, broadcasting, childcare, chimney sweeping, cleaning. Okay, that's rule of law, not taxable. Exception to that, washing and waxing of automobiles, taxable. Coin-operated laundry machines, not taxable. Exception, laundry services are taxable. Engineering, not taxable. Excavating, not taxable. Hairstyling, not taxable. Legal services, not taxable. You knew an attorney had to be in there. mowing, snowing, snow removal, towing, moving, and trash hauling, not taxable. So that's just a few services that aren't taxable. But teaching is not taxable. But if you are repairing tangible personal property or maintaining or working on tangible personal property, that'll be a taxable service. What is interesting is like physical memberships, admissions, places providing physical fitness. So memberships to fitness facilities, they consider recreational, which I kind of consider it torture, but yeah, they consider it recreation, so it's taxable. So, and what's interesting is if you have to go kind of case by case, but depending on what kind of class you offer there. One they consider, well, is the goal physical fitness or is the goal teaching? So one of them, I forget which one, if it's aerobics or what's the one with the happy hands? I forgot what it's called, but one of them they considered teaching, one of them they didn't, and to me they were so close I couldn't tell the difference. But it was just case by case. One of them was more teaching, and one of them was actually just recreational. So jazzercise, that's what I was thinking of. Jazzercise. Sorry, getting old, I forget these things. Warranties. Warranties are interesting. Intangibles, there's no sales tax on intangibles. Intangibles are like investments and interest and dividends and insurance. A warranty sure feels like insurance because the whole idea is, well, if something happens to this, we're going to make you whole. Well, it's taxable, by the way, if you sell a warranty. Well, I looked in the insurance statutes, and sure enough, it says warranties are not considered to be insurance. Warranties and maintenance contracts are in the same category, so they say the same thing. So if you sell a maintenance contract or a warranty, it's taxable. And so an extended warranty, that type of thing. Well, what does that mean if it's taxable? Well, here's what that means. First of all, you collect sales tax on the cost of it. That's it. So what does it mean if a customer comes and you have to honor, this broke, now you're going to replace it? Well, if you're just replacing it and no money changes hands, that's not a taxable transition. But a lot of these warranties have a copay, just like an insurance policy. So a lot of them have like $100 copay.
Hey, Carl.
Yeah.
Sorry to break in. What about language services, interpretation or translate from one language to another? Is that service sales taxable?
Nope. There's no tax on that.
Thank you, sir.
See, I could have been a smart aleck and said I don't understand, but I didn't do that. But
yeah, thanks for being polite.
Well, I'm an aleck. I'm just not a smart one, I guess. But is warranty, so anything that comes out of a customer's pocket is going to be taxable because it's going to be considered that portion has not had sales tax collected on it. Any portion covered under the warranty, it's considered that sales tax, since you pay sales tax when it's sold, it's going to be considered sales tax has already been paid on it. So I don't know if you've ever bought an extended warranty like on a car, and if you've ever had to have something fixed under it. If you notice, like there's usually a copay, they'll collect sales tax like on that $100 copay, but everything else, there's no tax on it because and they don't charge you for it because it's considered that sales tax has already been paid on that since you've paid sales tax on the purchase of that extended warranty. Gross receipts, this is very important. This one, it's easy to gloss over. But this one can get you in trouble. This one people will have questions on later too. This is what they call the tax base. Accountants will call the tax base. And what's the tax base? Tax base is on a taxable sell. Out of everything I charge my customer, what part of that is taxable? That's what we're talking about, the tax base. Okay, well, the tax base for retail sales is the selling price. It's gross receipts. And so in the definitions of gross receipts, it talks about, well, it's the selling price. And then in the definition of the selling price, it says any consideration. And then it defines in that, it says, well, you can't separately state and break out and remove things from that gross receipts like shipping, handling, delivery, service fees, things like that. So what that means is if those things are included in the selling price, they are part of the items, they become part of the items sold and become part of the tax base. So think of it this way. If like I show here, a $100 item, and it costs $10 to ship it, and I'm charging my customer for that, so $110. So now that $10 shipping charge just became part of the item I sold. So now it's a $110 item instead of $100. So I have to collect tax on $110. Normally, if all I did was ship something and I'm not selling it, well, shipping's not taxable in itself. But when it becomes part of gross receipts, now since it's tied to that and it becomes part of that item, part of the gross receipts, that's when it becomes taxable. So that's a hard concept to wrap your head around. So, because all the time people will say, well, I know shipping's not taxable. It's not taxable if that's all you're doing. But if you are selling something and you're charging that to your customer, it becomes part of the gross receipts. It becomes, just think of, becomes part of that total selling price. So then it becomes taxable, the gross receipts. Remember, the gross receipts is the total selling price. And the total selling price is going to be, the tax base is going to be what the amount you collect sales tax on. Manufacturer's coupons, manufacturer's rebates, very similar. Here's what that means. A manufacturer, manufacturing company, they a lot of times will have these coupons that they'll put in, used to have physical newspapers. I guess now they do it online and stuff. And people would cut them out and take them to the grocery store, things like that. And, you know, it'd take 50 cents off a can of this or $1 off of that. And when that happened, you know, you would get the discount, you know, the 50 cents or the $1. The grocery store still gets their asking price for whatever they're selling, but they get the money, you know, they get the money reimbursed by that manufacturer, whatever the discount is. Okay. So we're talking about gross receipts still. So we're saying, okay, remember selling price, the selling price. So here's what we're saying. That grocery store, if I had a 50 cents off of this $1.50 can of whatever, of corn, yeah, I'm going to get 50 cents off. This Del Monte or Libby or whoever. I give it to the grocery store. Well, the grocery store is still going to get that 50 cents, but it's just going to take a little longer. So what happens is they have to collect sales tax on the starting price, the $1.50. Then they apply the discount, the 50 cents. That manufacturer will send them that 50 cents. So how they apply the sales tax is they collect sales tax on the starting price, then apply the amount of the coupon. A store coupon or a store rebate means nobody is reimbursing the amount of that coupon, that discount. So if I had that same scenario where I had that 50 cents off a can of corn or whatever, and it's just that store had their own coupon, nobody's giving them any, nobody's reimbursing them for it. All they are really doing is lowering the price of that product. That's all they're doing. It's just what they did is required you to give them this to do it. So all they're going to do is they're going to collect sales tax on the final cost because that's all they have to do. So in that case, since it's a 50-cent coupon on a $1.50 item, they would just collect sales tax on the final cost, which they'd collect sales tax on the $1 because it's what we call a store coupon. So there's a big difference between a manufacturer's coupon, manufacturer's reimbursing the amount of the coupon, a store coupon, nobody's reimbursing it. Now, if you've ever looked at a grocery store receipt, that computer's doing a whole bunch. Now you know why. Now, invoice to the customer, receipt to the customer. There's two ways that Kansas will allow you to do that. The law, it says, well, one is you can itemize and show that, which I'm kind of showing you there at the top, just basic. You're just showing, what the sales tax is. And then you're used to that. You go anywhere, you go to a fast food place, they show it like that. No big deal for retail sales. Certain industries, we have a different method that we do recommend. And that is, well, you don't have to show the sales tax as long as you have this language on all of your invoices. Okay, that language is all applicable sales tax included. And then you don't have to show the sales tax. Now, the thing is you must have that language on there, because if you don't show the sales tax and don't have the language, whether you collected the sales tax or not, it's going to be considered that you didn't. And of course, they will apply, meaning auditors, they'll apply tax, penalty, and interest, nothing but bad things. So if you do the method where you don't show the sales tax, make sure you have the language, all applicable sales tax included. Now, if you're doing some type of business, now for construction contractors, we absolutely recommend this. We do recommend this for online businesses simply because most of the online platforms only have the ability to collect one rate per state, which is kind of crazy because most states have at least more than one. We have jurisdiction in their state. We have, I think, nearly 1,000 now. I know over 900. So that one rate doesn't do you any good. I know Texas, last I heard they had more than 1,800. And of course, we don't even want to talk about California or New York. So it's just not going to do you any good with that one rate per state if you're required to collect their sales tax. So if you did it this way, you wouldn't show it and then you would just back out the sales tax, which on our sales tax return and most everyone, you have to back that out to begin with because you're going to have to calculate it. But I showed you the statute where it talks about where you can separately state the sales tax and not show the sales tax, that type of thing. And it has that actual language in there. I had a lot of people, I had someone tell me that I made that language up. And I said, no, I copied it out of the statute. So I had to show them that. Well, the question I get a lot of is, well, what rate of tax do you collect in Kansas? Kansas is what they call destination-based sourcing. Now, all but 11 states are that. The other ones are what they call origin-based, but Kansas is destination-based. That means you collect the combined rate of sales tax that's in effect where the end user takes delivery. So that delivery, that's the important part. So if you sell something and they pick it up right here, well, they took delivery of it right here. So you collect the sales tax rate where you are right here. But if I go to Nebraska Furniture Mart and I go there and I pick up a couch, or let's say I go there and I pay for a couch and I say, deliver it to me in Topeka, they will need to collect the Topeka rate because that's where I'm taking delivery of it, the end user. Or if I told them deliver it to me in Bird City, they'd have to collect the Bird City rate. So there is, like I said, over 900 jurisdictions. Not every state is this, though. So you have to look up the rates. Now, how do you find the rates? Well, we have a publication called the KS 1700. That KS 1700 is actually a spreadsheet. And it's just a list of the jurisdictions. They update it quarterly because cities, counties have the ability to change their sales tax rates, and they take effect usually on the quarter. So either they've sunset and gone down, or they've voted on one and have a change. So there could be a change in sales tax rates. So they have that listed quarterly. But unless you know exactly what jurisdiction somebody's in, which most people don't, that's not going to be the way you want to find somebody's sales tax rate. What you're going to want to do is look it up. And in fact, I recommend you look it up on the Kansas Department of Revenue lookup sales tax rate locator on our website, simply because in our statute, it basically says if you've used our website to, if you've done your due diligence, use our website to find the sales tax rate, you will be covered by the good faith law. You will be covered if we were to give you an inaccurate rate. So where's the Where's the locator site? Well, this is
Carl?
what the,
Carl?
Yeah.
Real quick, will you discuss calculating the use tax on purchases both from in-state and out-of-state vendors?
what do we mean use tax on in-state?
I guess that's the thing that needs clarity. There's no use tax for in-state, right?
Well, it depends. What kind of business are we talking about? The only state use tax, in-state use tax there could be that we call in-state use tax are for motor vehicle dealers. And that's paid at the county
Okay.
because they're the only dealers have different sourcing than everybody else. In other words, they collect sales tax at the rate at their dealership. And then if that is not the, if the rate of tax at where your home registration is different, then you'd pay the difference. If it's more, you don't get a refund if it's less.
Okay.
So that's the only in-state as far as in the state. But yeah, I'll be talking about out of state
Okay.
when I talk about compensating use tax. Our Department of Revenue website, I have shrunk it down to look so you can see the whole thing. It's ADA compliant. So that means it's blown up to about 272%, I believe. So you only see the top half of it. So what I did is shrink it down so you could see the bottom half of it. There's more than one way to go to the locator. So I'm just showing you one of the easiest ways. Now, when I said to be covered, you have to do your due diligence. That means you just put in a complete address. So what you're going to want to do is calculate the sales tax by the address, not the calculate by zip code +4. Because if you use the zip code +4, that's all it uses, is nothing else. So if you do that, you'll type in the whole address. Now you do want the +4 if you can get it. And where do you get that +4 for the zip code? Well, go to the United States Post Office. That's the easiest place. And they're the ones that have that. So I don't recommend going to anywhere else because, you know, you might get some kind of virus or something. So I'd go to the United States Post Office and you type it in, they'll give you, you don't even have to have a complete address. They'll give you the zip code with the +4. The reason you want that +4 is, remember I was talking about those community improvement districts and stuff. There are some areas in the state where the zip code or the jurisdiction is different, right next to business, next to business, next to business, right across the street. They are that close. And that +4 is what makes that determination. So you could be collecting the wrong rate. And you don't want to collect, not enough because then that's, you know, penalty and interest. But you also don't want to collect too much if you don't have to. So that's how you would do that. And you would just type it in here. And then what happens is I typed in for that Ottawa. And it gives you a request number. I kind of circled it there, but it breaks it out just kind of to show you. But if you see the total rate up there, 11.6, but it breaks it out, shows the state, the Franklin County, City of Ottawa, and then that special jurisdiction is the 2%. But you want to save that.
Got another one here quick.
Okay.
What if I'm teaching a class and supplies are provided as part of the class? Is there tax charged on those supplies?
What kind of supplies? What do you mean charged? To whom?
Just a second. I'll open up her mic here.
Somebody's paying tax on them. So what that means is if I'm teaching a class, if I provide a book with the class, and I'm not selling a book, but here's a class. Oh yeah, I'm with the class, I'm giving you this book. Fine, but me, the teacher, I got to pay tax on the book when I buy them. That's what that means.
Elizabeth, did that answer your question?
Can you hear me?
Yep.
Okay. Yeah, thanks for taking my question. I guess I'm like, if I'm teaching a class on like dyeing yarn, that's the kind of thing I would teach. If I provide the dye and the physical supplies that we're using in the class that I have purchased, do I need to charge those people that take the class tax?
So all you're doing is teaching?
Yeah, I am teaching, and then I have, you know, materials that we're using in the class that I have purchased from somebody, you know, some other manufacturer. Do I need to charge the people taking the class for those supplies that they're using? They might, you know, take home basically the dye and the yarn.
You're
Sorry if it's
teaching.
confusing.
Yeah, you need to pay tax on those when you buy them if that's what you're going to do. So you're saying come to this. So the whole intent of the class is just teaching how to do it, not for somebody to come and, hey, I'm going to buy this thing.
They actually do it in the class. It's like a hands-on crafting
Right.
class.
But I mean, that's the intent. The intent is not to go home with something. The intent is to actually learn how to do it.
But they do, they would actually physically do it in the class and then bring their own thing home.
That's part of the teaching though, but I mean, that's incidental, right?
Yes.
So, but the intent is to teach them that.
Correct.
They're probably not going to be going there to over and over again to say, now I want you to make this or this, that type of thing.
Okay. So basically, because I've purchased the supplies and I paid tax, they don't have to then pay it to me again.
That's not the reason, but you can think of it that way, but that's really not the reason.
Okay.
But for teaching, if it's included with the class, you don't need to collect sales tax on those. But when you purchase those, you will need to.
Sure.
But
okay.
The reason I said that that's not the reason is in our tax law, it says you must collect sales tax on the gross receipts. And nowhere does it say that if you've paid sales tax on something that you only collect the difference, because that's a misconception people have. So what it means is even if you've paid sales tax on something you're selling, you must collect sales tax on the gross receipts. Now you can apply for a refund on the sales tax you paid on the purchase price, but you still have to collect sales tax on the gross receipts. Now, in this, that's why I emphasized that was not the reason why you're able to not collect sales tax on that, because I didn't want it could make you try to apply that law to something else, or try to apply that reasoning to something else.
Okay, thanks.
Yeah, you bet. Because I get the question all the time, well, if I just buy my stuff without tax, then I won't have to, or if I buy my stuff with tax, I won't have to collect tax. Sorry, it doesn't work that way. Okay. Yeah, if you do look up your sales tax, make sure you get that request number or print off the page. If you're using software, you go to the electronic services. They can, and you're using software, they can link it up so that it, you know, if you're typing in your software, it can go here and capture that number for you. See, another question. I don't know if there's any photographers, but one thing I get a lot of time with photographers is photography's kind of changed a little bit, but the old photographers, they take pictures and then you'd come back and you'd pick up your pictures. Well, that's tangible personal property, so they collect tax on, you know, the physical pictures, not a problem. Well, then stuff, you know, the world started changing. So then if I would request, someone would request, hey, can you just email me the pictures and I'll pay for them that way? Well, yeah, that can be done. Well, if that's the case, it doesn't become a physical item. So no sales tax on that. But then a lot of them say, well, no, here's what I'll do is I'll download it onto a DVD for you. Well, now it's a physical item again, so they collect tax on that. But now they don't do that anymore. What they do is they go up into some cloud somewhere and give people a code and people download it. Well, now it's not a physical item anymore. And it's, so one thing you got to look at, it's not a physical item. And let me see, one thing I got to be careful of with internet, is it pre-written computer software? Remember that tangible personal property definition? Well, no, it's not that either. So no sales tax if they give you a code and all you're doing is downloading it. So no sales tax on the purchase of that. So just letting you know, because that's how a lot of the photographers are doing that nowadays. They'll say, well, I'm going to take these pictures for you. You're paying for that. And download, no sales tax, no problem. Now, if you order those and then now I'm going to send them and then I'm going to sell you a physical item after you've ordered them, well, that's different. Now it's a physical item. So just letting you know. Now, if I'm selling pre-written computer software, that's different. That's defined as a physical item, even though it doesn't feel like it. And what's interesting, since it's defined as a physical item, a tangible personal property, even if it's downloaded onto your computer, if it's downloaded on your computer, that's taxable. So you got to think of it as being a physical item downloaded onto your computer.
Carl, hey, this is Carl Klein. We've got a question coming in on basically destination-based sales tax and how you get refunded for that. I'm going to read you the question. And we physically go to a vendor's location in Kansas. We pick up the item, which I think means purchase the item. We pay the sales tax in effect at the vendor's location. Now I fill out my use tax return. The tax at my location is different than the tax rate at the vendor's location, hence the tax that he paid. What does a person do? I think the question is, can he get a tax rebate or reduction for the difference that the sales tax is in the location that he's taking the item for use versus the sales tax that he paid?
Okay, totally misunderstood me. Use tax, first criteria, you bought it outside of the state of Kansas. So I haven't talked about use tax yet. So that's where people get confused because they think, well, it has to be, it's only for use tax. Destination sourcing, sales tax, combined rate of sales tax in effect where the end user takes delivery. So wherever the end user takes delivery, that's the rate of tax that you owe. So if you're the end user, wherever you pick it up, that's the rate of tax you owe, wherever you take delivery of it. So if like in Wichita, the rate of tax there is like 7.5%, one of the lowest in the state. If I go to Wichita and let's say I go to Menards in Wichita and I pick up a 2x4, 7.5%. That's a good deal. So I'm down there, I pick it up, I'm taking delivery of it there. I bring it back to Topeka. I don't owe the difference. It's 9.15%. Well, if I am up in Topeka though, and I go to Menards in Topeka, it's 9.15%. I pick up a 2x4. Well, if I go down to Wichita and live in Wichita, it's only 7.5% there. Well, I don't get a refund. Doesn't work that way because I picked it up in Topeka. Well, Topeka, they get their sales tax, rightfully so, because that's the jurisdiction. But when we talk about compensating use tax, what we're talking about then is something purchased outside of the state of Kansas. So if it's purchased outside of the state of Kansas, that's when they call it compensating use tax. So it's something you use, store, or consume that you purchased outside of the state of Kansas that you have not paid any sales tax on, or you haven't paid an amount equal to or greater than that Kansas combined rate of sales tax. So if I went to Wichita, Menards, and I bought, that 2x4, 7.5, and I bring it back to Topeka, I don't owe anything. But if I go further south, I go to Oklahoma, and I go to their Menards, if their rate is less than the one in Topeka, now I owe the difference in compensating use tax because now that's outside of this. That wasn't in Kansas. So that's what compensating use tax is. So unless you're a automobile dealer, and then even a dealer doesn't, the dealer just collects tax always The dealer doesn't even worry about it because the dealer just collects sales tax at their dealership. That's the only rate they worry about, unless they're selling parts, and then they're like everybody else with the destination sourcing. So yeah, it gets a bit confusing, just the wording of it. So I understand that. Sorry about that. And don't ever be afraid to ask a question, because I always tell everybody it took me 1,000 times to get it too. So did that answer the question? I don't see the questions very good here. So if you've typed a question, I missed it. I'm sorry.
Carl,
Okay.
yes,
No.
that answered the question. So thank you so much for the clarification.
Oh yeah, no problem. Thank you guys for letting me know when there's a question, because I'm oblivious to some of that. All right. Well, I've been talking about like stuff's taxable. Well, does that mean anyone can buy this without tax? Yes, there are exemptions. So I'll talk about exempt entities and then maybe how you guys can buy it without tax and that type of thing. Because, the first thing is, you get this number and it's like, well, am I able to buy stuff without tax, and how do I do it? So we'll talk about that. But first of all, I want to tell you what an exempt entity is. There's an exemption certificate book. It's the KS-1520, looks kind of like that. And on page, I believe it's 14 in that book, might be 15. We have a list of exempt entities. I want to take credit for listing all the exempt entities there, but there's a gal in my office that did a great job. Her name's Lynn. She did a super job. An exempt entity, first of all, is a nonprofit organization, but I always hate saying that, because what I want to emphasize is just because somebody's a nonprofit organization does not mean they are automatically exempt from sales tax. That nonprofit status is a federal income tax status, and it flows through to state income tax. So, it exempts income tax. Sales tax, different. So sales tax has this criteria here. So first of all, in order to qualify as a tax exempt entity, they have to first be a nonprofit organization. Then they must be listed in the exemptions to sales tax statute, which is statute 793606. They're either specifically listed or they're going to qualify under one of the categories listed there. If that takes place, then they must apply for this from the Department of Revenue. If they apply and are approved, then they're issued an exempt entity certificate. So it's a process. So it's not automatic.
Carl, sorry.
Yeah.
If all items sold by a company or delivered out of state by a third party, so a trucking company that makes the delivery, takes possession out of state, is there any Kansas sales tax charged?
No.
Okay.
No.
Thank you, sir.
You bet. So I forgot what I was saying. Just lost it. Oh, well, it must not have been important. Okay, that's what an exempt entity certificate looks like. So if they're issued an exempt entity certificate, not every nonprofit can get one. So if you look, it's very specific in 793606. So there are some specific exempt entities listed on there. So you'll see like All American Beef Battalion, Jazz in the Woods. But then you see categories like religious organizations, state of Kansas, things like that. So they're either going to qualify under a category or be specifically listed under there. And if they get issued a certificate, it'll look similar to this. It'll have an expiration date as well. So I'm showing you like the old certificate and then the new one. And you'll need to make sure it's not expired. They just renewed these last year. They all expire on the exact same date, no matter when they get their certificate. So they will all expire on October 1st, 2024. So make sure it's not expired. Now, most of the certificates you will be dealing with, if you're selling to a church, a city, a county, their exemption it'll say on the exemption certificate, by the way, it'll say that their exemption will exempt direct purchases only. What that means is in order for the purchase to be exempt, the money must come directly from that exempt entity. It cannot be a reimbursement. So I get that a lot. A lot of people say, well, we're buying it on behalf of them. Well, you might be taxable. We get that a lot. The example I like to give all the time, the reason I like to give it because it actually happened, was a pastor of a church goes to a hardware store, grabs a garden hose because they're going to use it for the baptismal to fill it up, and gives them their exempt entity certificate. He's authorized, signs it, gives them his bank card, his debit card. It's his personal debit card, and the hardware store tells him, well, I got to tax you because that's not a direct purchase. Shows them on the exempt entity certificate that the pastor is giving them. It's kind of hard for the exempt entity to argue when it's on the certificate they're giving you. It says right on there. And in fact, on the bottom of the certificate, on the retailer's information, second bullet, it'll say exactly what it covers and what you're supposed to do. In fact, that second, on retailer's information, the second bullet, that answers about 95% of the questions I get. And that retailer information is on most of these certificates. It's just about the same. It says payment must be made by the entity on their checking account or on a credit debit card issued to the entity. Acceptance of cash, personal check, or personal credit debit card is not allowed for an exempt purchase. So basically saying that money must come directly from them. Now, if he had a church debit card, no problem. Church check. If they had a direct billing account to them, no problem. But nope, they can't use petty cash. No tracking on that. So that says it on the certificate, though. So that is a direct purchase. So that's how that exempt entity. Now, if they have say I sell to this church, all the time, they're coming in and they buy this, whatever it is I'm selling all the time. Well, I can blanket this certificate, meaning blanket means multiple sales to them. And that would be multiples defined as more than one within a 12-month period. So that is what we call an exempt entity certificate. If you're selling to one of them, make sure you take a copy. You really want to take a copy of this, because if you're ever audited, you want to be covered under the good faith law. Here's why. Remember, the default in Kansas is everything is taxable. So right now, if you're selling something, the auditor's looking at whatever it is you sold as being taxable and saying, okay, you owe tax on it until you show me something that good reason why you do not owe tax on it. If all you took down was a number, that's really not proof, because you actually need a signature. Okay? So what you need is a certificate. So what these are an affidavit. So if this, if the person from the church or school or city signs this, what they're doing is they're saying, hey, I'm going to use this appropriately, use it for what we're exempt for, and I am exempt for this. And so they're signing it. Well, they are now taking the responsibility of the sales tax over from you. Now they're responsible for it. You are covered, and you are taking it in good faith. So now you're covered by the good faith law. You are covered because you took it in good faith. You have their signature, affidavit, you put this in your record, and you make sure it's not expired. You don't have that, now you're not covered. So you always want a copy of that. And don't let them give you a hard time. And here's the thing, if someone gives you a hard time about any sales tax or any of these, never take the heat for it, because it's not your fault. Go ahead and blame it on Department of Revenue. It's not our fault either. I always tell people it kind of feels like, there's this board game and we're kind of just like reading the inside box lid, the rules of the game, because, that's just the rules of the game. We don't make it up either. It's just how it goes. And the thing is, a lot of the people at the legislature, they didn't make it up either, because they've been around a long time. So let's see here. Now, for you guys are not a tax exempt entity. You guys have a sales tax number. Now, it's called a sales tax registration, okay? So when you apply, you got a sales tax registration. I'm guessing most of you have a sales tax number. And when you got a number, you got a registration certificate. I'm going to try to hold that up so you can see it. Looks something like that. And that is your registration certificate. And if you notice, they X out like all but like the last few numbers. The reason they do that is we have to comply with the IRS rules for registration numbers on anything we mail. When you use anything, you're going to be writing your whole number. Don't X it out, okay? It's a sales tax number. It won't hurt you. So I wish we didn't used to do that, but we're never going to use a social security number. IRS will never use a social security number. So anyway, when you get one of these, make a copy of it. It's going to have the letter and everything on it, but make a couple copies of that, because a lot of places will want a copy of this. And by the way, people will call this the wrong thing. They'll call this an exemption certificate. It's not an exemption certificate. This is your sales tax registration certificate. What this means is you are registered to collect and remit sales tax. You're legitimate. That's why they want it, is to show that you're legitimate, but they will call it a exemption certificate. Okay, it's all right if they call it the wrong thing. Just try to know what they're saying. So what you do though with that number is you use that number on exemption certificates. That's what you do. So we have exemption certificates on our website that you just print off. They're on the public website. You don't need a special passcode or anything to get to them. In fact, in this book, we have them, and the book's available. It's on page 38. It's the resale exemption certificate. That's the most used certificate we have. It's on page 38. It's an ST, like sales tax, ST-28, A as an apple. It's a resale exemption certificate. And again, it's an affidavit. Basically, you're going to give it to whoever you're buying the stuff you're selling, your vendor. And what it says is, hey, I'm buying this stuff and I'm going to sell it. And if for some reason I don't sell it and I use it myself or something like that, I will pay the sales tax on it. And what that means is I'm going to pay the sales tax on what I paid for it. And that you're signing, so whoever takes this, they are taking it in good faith. Okay? So again, you use your sales tax number on this. So you're not, a lot of people think, well, don't I get issued an exemption number? No. You got issued a sales tax registration number, a sales tax number that you use on exemption certificates. And so this is one, you're giving it to your vendor. It's their good reason why they didn't collect tax from you. Or let's say let's say you're selling some apple butter just because I like apple butter. Or what I really like is that syrup that Tom gets. But and I'm going to get, let's say, 2 cases of this apple butter, and I'm going to go sell it out in western Kansas, maybe Goodland. And I'm going to buy that from you without tax. I'm going to give you one of these resale exemption certificates so that you don't charge me tax. You are going to take one of these resale exemption certificates and put it in your records. Heaven forbid you're ever audited. That's your good reason why you didn't charge me tax. Well, you just act like a wholesaler, didn't you? Happens, no problem. That's a good reason. No problem at all. Now, here's another thing. Here's what happens a lot of times, especially people, and they don't realize it. Well, I have this apple butter. I'm going to open this up and I'm going to give away free samples. Yep. Good idea. People taste how good that is. They're going to want 2-3 jars of it. But the one I gave away, guess what? In order to give something away, I have to own it. If I own it, I'm considered to be the end user. What does that mean? That means I owe sales tax on it, don't it? I owe sales tax on that apple butter now. my cost, what I paid for it. I bought it without tax. What do? Here's what I do, which I'll show you here. On my sales tax return, I'll remit the tax. I'll pay the sales tax on a line on the sales tax return. It's called consumed, or not consumed, merchandise consumed. I'm sorry, merchandise consumed. And I'll show you on the sales tax return. So the same thing as if I donated it to somebody. Now, I say that there's an exception to that. There's a law that says, well, if I donate that to one of those exempt entities, meaning one of these organizations that have an exempt entity certificate, if I donate something, one of those inventory items that I bought without sales tax, if I donate it to one of these people, then I won't owe sales tax on it. So I need to get an exempt entity certificate from them for that donation. Okay? That's the exception. But if I donate it to a nonprofit and they don't have one of these, which there are a lot of them, I can still donate it, but I'm just going to owe the sales tax at my cost on that item I donated. Just FYI.
Hey, Carl.
Okay. Yeah.
We've got a question here. Just a second. I'm going to let her ask you directly. Okay.
Okay. All right.
Have to find her on the list here. Rona?
Hello, hello.
Had to unmute. Sorry.
There you go.
Okay. Back on her question, that you were talking about the preacher going in to buy supplies or whatever from a business, using the business card. What if the church or the entity sets up a charge account?
Yeah, if they have a direct pay account, that's just, the church is paying the account to that hardware store.
Right.
They're paying it directly. That's the main thing, is where's the money coming? Is the money coming directly from that entity? So we have a direct payment to them. Yeah, that's
Right.
That's exempt.
Right. Okay. I just wanted to clarify that hadn't changed in all these years.
Did that scare you?
There for a minute it did.
Oh, sorry about that. Yeah. That's just fine. I mean, that's a good way to do it, in fact, because now you know for sure that the money's coming directly from them. So yeah, absolutely, that's a direct payment.
Okay.
In fact, I learned I probably shouldn't tell you guys this, but I learned a couple. I told people I learned a couple things from churches that I get questions a couple times a year from people that are members of churches, and they'll say, well, I want to buy this thing for my church and I want to donate it to my church anonymously. How do I do that? I know we're tax exempt. How do I buy it without tax? Well, you all know now that they can't do that because that's not a direct purchase. So I have to tell them, well, if you want it without tax, it has to be a direct purchase. I try to inform them and I say, well, you can, donate the money to your church and, have them earmark it for whatever it is, and they can buy it directly themselves. And I always tell everybody the two things I learned from that is, one, that people that go to church will curse at you too, and two, I was told that I stole their blessing. So that's the two things I learned on that one. And it was an 80-year-old woman who cursed me out on that. So that was it. That was quite a day. It was a Monday too, so I figured. Okay, I told you about the resale exemption certificate. I'm going to tell you about the ingredient component part. It's very similar to that resale exemption certificate, but slightly different. Very similar. The resale exemption certificate is really designed for, well, I just buy this thing and I sell it, okay? Ingredient component part is designed for something that I have to put together and sell it. So if I'm cooking something, I buy ingredients for it. If I'm making something, I buy all these pieces of it and put it together. So I always like to give my greasy cheeseburger, So I'll tell you about this. If I sell greasy cheeseburgers and they're all to go, Well, I can buy all the ingredients for that greasy cheeseburger without sales tax. So they're ingredients. So hamburger buns and bacon and whatever you put on there, all those ingredients, that makes sense, right? I can buy just a little more. I can buy that paper that I wrap the burgers in. Okay. I can buy the sack that I put it in. If I sell soda pop, that to-go cups and lids and straws and napkins that goes with if it goes with the thing I sell, if it goes with it, does not come back, it goes with the product, it's considered to be an ingredient component part, and I can buy it without sales tax. Now, if it's something I use for my business, no, I can't. So if it's a consumable I use for my business, like, well, what about the stuff I spray on my counter? No, I've used that. I'm the end user of that. That's part of my business cost. But if it's something that goes with the product, so if let's say I'm an online business, I pretty much buy these boxes all the time. I can buy those boxes without sales tax. I was packing peanuts, tape, ingredient component part. So that's a big one. So you want to fill that out and give that to your supplier for that. Now, here's the thing I want you to be aware of. A lot of times, whoever you're buying this from might not know that this even exists because they don't know sales tax that much. They'll say, give me a resale exemption certificate. It's okay. You don't care. I'm just letting you know you're allowed to buy those things without sales tax. You could argue you're selling all those things incrementally. So, but if they ask for it, give it to them. You don't care. But what I want you to be aware of, the ingredient component part, what you're able to buy those things that go with the product as ingredient component parts. There's one I don't have listed on here that I need to put on there. If you buy stuff that you're going to sell outside of the state of Kansas, a lot of times they won't accept a Kansas resale exemption certificate or an ingredient component part exemption certificate. We have one more certificate. It's called a multi-jurisdiction, an ST-28M. And by the way, this one's the ST-28D. The ST-28M is multi-jurisdiction. That one, most states will accept. So I could give them that one. It'll work for resale and ingredient component parts. Also, you could use that one if, let's say, a manufacturer or a retailer or a wholesaler from another state is buying something from you. You can have them fill out that multi-jurisdiction. And because a lot of times wholesalers don't have a number at all. That multi-jurisdiction works for that if you're selling to them. So just FYI.
Hey, Carl.
Yeah.
Got a couple questions here quick. Is this a good place to break in?
Sure.
Buying supplies, I use the resale certificate, then sell the item out of state. The tax is not collected at any of these points. So they buy it for resale and don't pay sales tax with their exemption certificate.
Yeah.
Then they sell it out of state.
Right.
Is there sales tax involved anywhere in that process?
Not for you. On the other end, the end user will owe compensating use tax for their state if their state has tax.
Okay.
But not for the seller.
The seller won't have to collect anything.
No, they thought it was too good to be true, huh?
Right. And then for a veterinarian,
Yeah.
I may just go ahead and let her ask directly because this is it's a pretty involved question. Nora?
Okay.
Sure. So I actually had two questions. One is I'm confused about the documentation that I need to have in order to use. So there's a list of items for which veterinarians are exempt from charging tax. Do I need to have some sort of documentation, or which documentation do I need to fill out in order to not charge tax for anything on that list? Or can I just not charge tax for anything on that list, such as prescription drugs?
Yeah, we've had questions about that one. I would use the veterinarian. We have the veterinarian exemption certificate.
Just fill that out and have that on file.
Yes.
Okay.
There's there's another one. Most people know, veterinarians know that one, and they know the resale. There's actually another one that would work that I would tell you about, and I'm trying to find it for you. Sorry. I call it generic. And if you can't find one, well, which one do I use? This is what you use. I'll show you. Because you're right. What's interesting with veterinarians, they kind of like have this category that like farmers have. One of the things you guys, no, I'm thinking of dentists. Do you guys use you guys don't use nitrous, do you? I was thinking,
Not usually.
I was thinking, I guess it was dentists. They use nitrous. Well, their nitrous is exempt, but the tanks they come in are not. Same
So
way with,
we do have some oddities like that, especially when I'm working for someone who is a cattle producer, so they're tax exempt. And
yes.
I have lots of questions about how to figure that out, and maybe this is not the right place and time to do that, but how can I get with somebody that'll help me make sure that I'm doing that right?
Well, yeah, you get my contact information. Yeah, with the gloves and
Okay, that sounds good. I'll maybe just contact you directly then. Thanks.
yeah. Now have you seen the agriculture booklet that we have?
Yeah.
Okay. Yeah. The form that I was talking about, if you all else fails, it's the ST28. There's no letter behind it. It's the designated or generic exemption certificate. So that one works too, because I know exactly what you're saying. There was we had to change that form about 2 or 3 years ago because there's a regulation that changed in there. Yeah, and yeah, take down my email and phone number and be happy to help you. And always don't be afraid to write for a private letter ruling as well to protect yourself if you have a question on something. So, and I can help you with that.
Wonderful. Thank you.
You bet. See, I like the questions because it entertains me, so that's super. Let's see this ingredient component part. Are there any farmers, anybody deal with farming? I can, because the agriculture exemption, that's one that's kind of, a lot of people misunderstand. I can just briefly mention if you sell to a farmer, their exemption covers ingredient component parts, what they call consumed in production, propane for agricultural use. Like I was just telling her, like the gas for, it was for the dentist, of course. The gas is exempt, but the tank they come in taxable. It's the same for farmers with propane. The gas is exempt, but the tank it comes in is taxable. But the big one for farmers is something called farm machinery and equipment. Farm machine equipment's exempt, but then you got to realize what's not exempt, and that's the part you got to try to make people understand. On the certificate, we list down just a few things, say, well, what's exempt. Well, most people kind of know some of the stuff like combines and discs and tractors and hay balers and irrigation equipment. Not all irrigation equipment's exempt though. Your irrigation equipment, if you know anything about irrigation at the pivot, if it's above ground, pretty much that's going to be exempt. Exception to that would be like the electric panel, except on the pole is not, but all the rest of the irrigation is, and then pipe in the ground is not. But then you look at what's taxable. This is what'll get you: air compressors and tanks, ATVs, all-terrain vehicles, automobiles, motor vehicles. That's interesting that automobiles are taxable, because you look in the definition of one of the main things this was exempt is for implements of husbandry. In the definition of implements of husbandry, it says automobiles are not implements of husbandry. So really, that's kind of where it comes from. Buildings, barn ventilators, bulldozers are not, they are taxable. Fencing materials and grain bins, hand tools, garden hoses, silos, water and gas wells, welding equipment, and any equipment that becomes part of building facility or land improvement. So any land improvement, any building, That's why fencing is taxable for farmers, and that, you know, I'll always have them say, well, it's required for me to keep my cattle in. No one argues that it's absolutely required. It's just not exempt because that's the way the statute reads. So just FYI. So if anyone has a question on the agriculture, just let me know. I've done classes just on agriculture before, and it kind of crosses over with the veterinarians. I've done that before, so that's great. So tools of the trade are taxable. That means the stuff that allows you guys to do what it is you do, whatever it is you're selling. So what are tools of the trade? Well, that could be your computer. If you have a display cabinet, if you any tables, your pins. They consider kind of weird. They consider like tools of the trade also things like sticky notes. Also, the cash register receipt itself, which to me I thought would be ingredient component part because part of it goes with the. They said no, it's a tool or possibly consumable. So you have to pay tax on the receipt paper and the ink for it, which that I don't always agree with the law, but that's just the way it goes. But if you buy a tool, you're going to need to keep the receipt for it. And when we talk about compensating use tax, that's the big one if you bought it in another state and didn't pay tax on it. Now, if they audit you, they're going to probably come out with a copy of your federal return. If it's a piece of equipment or tool that you're depreciating, they're going to have a copy of that federal return and say, we see you're depreciating that. We just need to see receipts to show that you paid either sales tax or compensating use tax on that. So that's one of the ways they look at that. Now, can you ever buy any equipment or tools without tax? Sure you can. There's something called an isolated or occasional sale. That would be things like a garage sale that people can have twice a year. So basically the items that they're selling were not purchased for the purpose of selling. And it's not a reoccurring event, that type of thing. So yeah, if you do buy it at a garage sale, you know, write down a date. If you can get a signature, that helps. If there's any kind of ad for the event, the garage sale, you know, cut it out, just put it in your records. Anything like that would just help. But if you're not depreciating, chances are you're going to be okay with that. If it's something you purchased before you opened your business and doesn't, and you're not depreciating, chances are it's not going to be an issue anyway. So just letting you know. But any purchases from this point forward, you'll be required to pay sales tax on that, or compensating use tax, and that's one that could get you in a little trouble if you didn't know about that. Oh, there's the A word. Sorry about that. Audits. Okay, the statute of limitations 3 years. So that means you need to keep all of your records, all your exemption certificates, all the invoices, all the receipt paper, all these books, all the tools, all returns, copies of your returns for 3 years, for the year you're in and 3 additional years back. If you are keeping these receipts, by the way, on the receipt paper, and you're using that hand sanitizer, be careful, because we've seen some people, it really erases those receipts completely. So that's been happening since that hand sanitizer stuff's been really utilized a lot. So be careful of that.
Carl, another good question for you.
Okay.
We run an Airbnb out of our primary or only our residence. We bought a camper to provide us a living space while guests are in our home. What can be claimed as business expenses on their tax return?
Well, that's going to be federal tax. So that's not sales tax. So you'll have to ask an IRS guy on that.
Okay.
But yeah, I would, I'd probably give you wrong information on that, but
Okay. Thank you, sir.
yeah, that's the thing, is this is just one little slice of the pie. So I'm sure you're going to have some business expenses there you will be able to claim. And does the Small Business Development Center still offer the IRS classes? I know you guys had Ross do that for a while.
Carl, no, we have not done any of those ever since COVID struck. So maybe we'll get back to those at some point, but those have always been very good.
Yeah, and I just talked to Ross just a couple weeks ago too. So that'd probably be good. Folks would really like that.
One more quick, Carl.
Yeah.
We service residential appliances and HVAC as a third party. Our contracting company is tax exempt, so we don't collect tax on their behalf. My
He's in the wrong
is,
class.
when we are performing services directly for homeowners, what taxes are we responsible for collecting?
I got to teach a whole different class now.
We try to keep your life interesting.
You need to pay tax on your materials and collect tax on the labor to install them is the default. When you say your customer, did he say residential? Or is this commercial? I didn't catch that.
He said residential.
And it's appliances?
Appliances and HVAC.
Okay, so HVAC for us, we don't consider an appliance. If it's affixed to real property, it's real property. It's permanently affixed. If it's built into the real property, it's real property. Which for a contractor, that should be good news because that means if it's residential, there's no tax on the labor. You still pay tax on the materials. So you'd go pay tax on the materials and there's no tax on the labor. And then how do you get your tax back on the materials that you paid? You mark up, meaning you charge more for the materials than you paid for it. And your customer never owes sales tax on materials because you're the end user of materials. Construction contractor, that's what you're considered to be when you're working on real property, is always the end user of materials because the second they install the tangible personal property into the real property, they turn it into real property. It no longer exists in this universe as tangible personal property. That's the point at which you became the end user. So now you owe sales tax. So what I'm telling you is you never show sales tax on materials. Your customer should never see sales tax on materials. They will absolutely feel it though. It just won't be called sales tax. If it's not materials, it's labor for taxability purposes. So you pay tax on your materials. And if the markup is going to follow the taxability of the labor, because the markup is labor. So you just throw that into labor for calculating your tax, which there is none. So there'd be no tax on the labor of that. What's residential? A place where somebody customarily lives. So that'd be a house, a mobile home, so long as it's hardwired, hard plumb, apartment, the living units in the apartment, common areas, no. Traditional nursing home, the individual bedrooms, the common areas, no. Hotels are not, those are transient. And then the other question, so appliances are not real property though, if they're freestanding, like a refrigerator, a washer and a dryer, a microwave, that type of thing. That's tangible personal property. So that's like this class. So you're collecting sales tax on the gross receipts. So now you go buy your parts without tax, and then you collect tax on the gross receipts, the selling price. So there is no designation for residential or original construction or that type of thing. So again, that's why for a contractor or someone who works on stuff like what you're working on, we recommend your invoice to your customer says all applicable sales tax included and don't show any sales tax. What that language means is if whatever I did for you sold to you was taxable, I collected the appropriate amount. If whatever I did wasn't, I didn't. And I just put that on all of my invoices. that protects you because contractors get short paid sales tax more than anybody. So that's how I would handle that. And you got like a little bit of a class scrunched into that amount, but if you have more questions, let me know. I don't know. Did that answer any of your question? Or I think
I just asking him here if we need to let him talk to you or not. That answer it for you, Justin?
because I can.
Justin, go ahead.
Yes, it did answer my question. That clarified it.
Good
Because
deal.
On some
thought I
calls
heard-
we go, yeah.
I thought I heard something about a maintenance contract.
Yeah, we contract with a large company that sells appliances and HVAC equipment. And so they contract us to go out and do warranty repairs. But a lot of these customers that we do warranty repairs for, they become our customers and they call us outside of their warranty. So then it gets hairy from there.
Yeah. See, but what's interesting is with the maintenance contracts on those appliances like that and the home warranty stuff, because they sort of commingle. We have a notice out there that talks about since some of the stuff they do becomes not taxable because of labor, they sell those maintenance contracts without sales tax. So it pretty much puts the sales tax, the onus of the law onto you as the contractor. So yeah, great for you, right? Easy for them. So my hat's off to you, buddy. But keep my contact information if you got questions, because you're in one of the toughest sectors there for sales tax. So just let me know. And I think next week we have a contractor class.
Yep.
So feel
Yeah,
free
I'm
to.
registered for that.
Today.
All right. Well, so, okay, you got both of them. So that's good. Then you're in the right class. You need both of them anyway. So good.
Thank you.
You bet.
Thanks, Carl.
No problem. Sales tax numbers. I always tell people this real quick because a lot of people kind of freak out about that number. Nothing magical about it. 004 is our code for sales tax. If you have an EIN, you get that from the IRS. Basically, it's just your business's social security number, I guess, but it's going to include that in the sales tax number. So you need that first. F is just another code we use, and then dash is, most of them are going to be 01 because it's the number of locations you have for your business. Most people have one location for their business, but if you have two, you'll have a 02. So nothing magical. So even before you apply for your sales tax number, if you have your EIN, we can pretty much guess what your sales tax number is going to be. So don't freak out too much about it. But a lot of people get panicked. So don't panic. If you need to apply, real quick on our website, you'll go up to customer service and then you'll go over here and register now. And then that's as far as I can go. They don't let me into, I don't have access to the live system there. I used to. I got accused of locking the system up, which I very well could have. I don't know. So I can't get in there. So I'm sorry. So that's as far as I can go. How often do you need to send in your money to file what they call file your sales tax return or your filing frequency? Well, when you register for your sales tax number, what it's trying to do is put you in one of these brackets, these filing frequencies. It's based on how much sales tax in a year you're collecting, not your gross sales, but the sales tax you're collecting. So a lot of people that first register get confused and they base it on their gross sales and they're like, why am I monthly when I should be annual? Or why am I prepaid monthly? So because they got confused. So the thing is, the threshold, it changes by the penny here, which is interesting. So $400 or less in a year in sales tax that you're collecting is annual. Now here's the thing, annual is the hardest one to remember. And it's the one that people go into collections for the most, meaning they forgot and they got a letter and they didn't. What happens is if you don't file a sales tax return, even if you didn't have any sales, you still have to file a sales tax return. If you don't file that, that computer sends out these nasty letters and it creates what they call a setup return. It says, well, worst case scenario, you said this, so we're going to say you owe us this. And it'll file this this warrant type thing. And then if you don't respond in a certain number of days, they file it with the court and they create an actual debt when you don't really owe it because you didn't have any sales. But once they file it, then you have a debt that doesn't go away. So I always tell people, if you're an annual filer, do something to remind yourself. It's the 25th of January. For sales tax, the 25th is the magic number, 25th. And annual is weird because January 25th is just not an easy date to remember. Quarterly, it's 400 and a penny to $4,000. So that's in sales tax. Remember that. So April, July, October, January 25th. Monthly, well, guess what day of the month? 25th, except for December. Then it's the next business day. And then the advance pay or prepaid, that means these folks are collecting more than $40,000 in a year. So, or in sales tax. So when you see those big box stores, you know they're all paying ahead. So by the 15th of the month, they've already paid for the month and they're paying again by the end of the month. So if you're, I don't know if maybe there might be some advance pay here now. So that's what the filing frequency is. Now we pick it for you. So you could get if your filing frequencies change, you don't change it. We do. So if you don't hear from us, you just keep doing what you're doing. But if you hear, they do this calculation once a year. So the time they would send a letter would be somewhere around September, October, somewhere in there. So if you get a letter around then it'll say, well, so let's say you were annual, and they'll say, well, starting January 1, you'll be quarterly. You'll need to file your return April, July, October, January 25th. So they'll tell you in advance that you'll need to start January 1st to be quarterly. You know, basically at the start of the year, you'll start being quarterly. So they give you advance warning. Or you could go the other way. Maybe you were monthly and you go down to quarterly. So just letting you know. Again, I don't have access to the live system. This was a test site I had access to. So the sales tax return, I'm just going to show you a little bit what it sort of looks like. It looks a little different than this because this was a test site, but I can answer, you know, what stuff is, but this still might help. When you register, you'll get your sales tax number and you'll manage it. You'll probably register a bank account. Most people do pay online now. Years ago, they didn't. Okay, original return. Most people know what that is. That's when first time you file any kind of return. Amended return. A lot of people know what that is, but some people don't. When you amend a return, that means, well, there's something I got to change on that first return. Something's got to change, so I need to fix it. So you amend it. When you amend a return, you have to do the whole return over. You don't just do the corrections, you do the whole thing over, and it takes the place of the original. Okay, well, here's what was happening years ago is, remember those annual filers, January 25th. Well, a lot of times, here's what you need to realize. A lot of times you had people that would have these sales, and yeah, they owed sales tax because, you know, $400 in sales tax. These people say, I don't want to risk, you know, being late or anything or missing it or something. I want to send in my money. Well, they had to amend, they'd start a return, then they'd send it in, so they have to amend a return. So I hate amending the return. So what they did is they created this additional return. So what this additional return does is, well, you start this return, and the additional return says, well, yeah, I know there's a return there. We're just adding to that return. It's an addition to it, adding a payment to it. And so those annual filers like that, because so if they have sales, they can just add to it and not have to amend the return just for that payment. And it comes in handy for them. So that's what that is, if you ever wanted to know what an additional return is. And then you see right there where it says no sales tax activity. They made that easy if you didn't have any sales tax activity, which that happens for some people. You put that, mark that, and you're pretty much done. Most people will be multi-jurisdiction for the sales tax return. That's an ST36. That means I have a likelihood, or I can sell in any jurisdiction in Kansas. If I have a fixed location and I will never sell in any other location in Kansas or anywhere, I'm going to have a single jurisdiction, which is an ST16. At some point, the ST16 will go away because you could file a single jurisdiction on a ST36 as well. But anyway, depending on what you have, an ST16 already has your jurisdiction listed on it. You don't have to look it up, but they're in every other way, it's the same. The ST36, it's the same as the 16 as well, but you have to look up all the jurisdictions you sold in. That's what the difference is. It seems kind of backwards because you start with part 3, you'll go to part 2 and then part 1. So that's, I don't know why it goes that way, but anyway, part 3, okay, what jurisdictions did I sell in? I could have sold in only one. It's no big deal. Okay, so I look up all the jurisdictions I sold in. Now, I just put 3 here. Your gross sales, this confuses people. What we want in there is all of your sales, your taxable and non-taxable sales. Now, your non-taxable sales do not have tax in it, of course, but your taxable sales, we want all the tax removed from that. So that gross sales is going to reflect all of your sales with no tax in it for that jurisdiction. You'll do that for each jurisdiction. So you'll have to back out the sales tax for all the sales, all your taxable sales in each of those jurisdictions. Okay, now merchandise consumed. Remember that merchandise consumed. Remember something I purchased, an inventory item that I used myself. I either donated it or gave it away, and I owe tax on it at my cost. This is where I report it, merchandise consumed. So if I donated a pair of shoes, maybe I buy them for $50, I sell them for 100, but I buy them for 50. I owe sales tax on them what I pay for them. So I would report $50 right here. Okay, just FYI. Okay, and then deductions. Well, there's a lot of things I have to deduct. If I sold something and had it delivered outside of the state, well, I deduct it right there. If I sold maybe a church, well, I deduct it right there. So I could have all of my sales and they were exempt. So I'd report it right there in the gross sales, and then I'd be just deducting it right back out in the deductions. So all I'm doing is accounting for it. So, because I have a lot of people freak out and say, well, I didn't do anything taxable. No problem. We're showing gross sales and they'll get deducted right back out in the part 2 and be zero that you owe. You're just accounting for it. No big deal. So you're doing that for each jurisdiction you sold in. Part 2, so this is for each jurisdiction. Part 2 says, okay, those deductions for all jurisdictions, we don't care what jurisdictions, just to the best of your ability, describe what they are. I say that they list, there's 101, who knows how many, but if you do not see one that describes what that exemption or that deduction is for, put it in where it says N, other allowable deductions. Like for our contractors, I always tell them that's where you put your tax paid materials and tax paid subcontractors, but there could be other things that you don't know where it would go. The veterinarian could put, oh, I bought some stuff that I didn't know where to put it. Well, put it right there, other allowable deductions. Remember this, if you're audited, this is not your proof that something was not taxable. Your proof are all those documents that you keep. Remember that paper that you, and by the way, you could scan those and keep them electronically. That's fine. Just make sure you back them up and don't store them near a giant magnet. So the part 2, this will be all the non-taxable stuff deducted out of that. So all of this was started up in this gross sales, and you're going to be deducting it out right here. And then part 1, That's where the rubber hits the road, because it starts with tax. And then if you see there where it talks about, by the way, the part 2 there, or part 2, it says number 2 and it says part 4. Utility companies have an extra part. So if you're not a utility company, and I don't think anyone is here, you don't have to worry about that. They have a whole nother section to fill out. And then the estimated and the credit, that's for the prepaid monthly folks. Because remember, they're advance paying, so they estimate ahead, and then sometimes they have a credit, that type of thing. Penalty and interest. If you think you owe a penalty and interest, you're welcome to do that. I had somebody that was putting penalty and interest every time they filed. And he said, well, I just wanted to be safe. And I'm like, that, it doesn't work out that way. Here's the thing, you'd be paying that every time, and one time, you might be late and owe it, they're still going to charge you penalty and interest. They don't do that thing where they say, oh, it all works out in the wash. So don't do that. If you don't know it, don't pay it. We really don't want you paying any more than you have to, believe me. The reason why is we want you to stay in business. It does the state no good if you're not able to stay in business. So we really want you to stay in business and pay the least amount that you really have to. But total amount due, well, that's what you pay. And then what we're talking about here is just make sure it's paid by that 25th date. So you can send in a voucher, make sure you have that postal stamp date on that envelope mailed out. Make sure it's mailed out by the 25th. It talks about, well, if you don't, gives you the time frame. If you don't do it by the 4 o'clock time frame, it won't get credit till that next day and that type of thing. A lot of people get this mixed up, and we'll do it on the 26th, which even then, depending on the amount, you probably wouldn't have a lot of penalty, but I still recommend you do it by the 24th or so, no later than the 25th. I show this screen because a lot of people get to this screen and they think they have already filed. This is the screen where you actually submit the return. This is right here we used to have the paper returns, which now you have to file electronically online. We no longer have the paper return you file. But this kind of puts it in a format that looks like the old paper returns, but you have to submit the return. You have filed when you get a confirmation number. That's what I tell everybody. So get that confirmation number. Make sure you keep a copy of the confirmation number. Because if something were to happen, like our system were to glitch and lose it, the return, like it deleted it somehow, at least you wouldn't be late if you have that confirmation number, and they sometimes can recapture it or rebuild it or something. So keep that number, print the screen or something. Also, where it says view printable return, that's where you can copy, print it and put it into PDF and save your own copy. You'll have access to review what you have filed already. And we've had no issues with that, but make sure you have your own copy too. Don't rely just on the state's copy. I always recommend that. So customer service, well, it's just our general customer service. We used to have electronic services, but now it's all into one. So that's our general customer service number, the 785-368-8222. And it's on the back of our books. It's everywhere. And I'm sorry that it's the number where you press 1 for this, press 2 for this. And I believe for sales tax, it's like 5 and then 5 or something like that, 5 or 2 or something. I don't know.
Hey, Carl, we've got one that's pretty involved, so I'm going to let her ask you directly here.
Okay.
Okay, ready?
Yeah.
Mary Ann?
Yes, hi. I am selling online, but I'm also selling to retailers who will sell the products, so part wholesale. And what my question is so the sales to the retailer, you were putting that as a deduction in the form previously. So do I list that as a deduction in the jurisdiction that I am within, or the store is within?
Sales, did I put it on mute? You can hear me, right?
Yep.
Oh, okay. I thought I put it on mute. Okay, so it'd be where they took delivery of it as far as, unless you sell it outside of the state. If you sell it outside of the state, I would put that in my home jurisdiction.
Okay.
And and you'd be okay if you put it in your home jurisdiction. That's probably the easiest to keep track of it. But yeah, and just take a resale exemption certificate from them. And if you have multiple sales to them, you can blanket that. But if for some reason you have to deliver it to them, you'll probably have to put it in a different jurisdiction.
Okay. Okay.
But normally that'll go in your home jurisdiction.
Thank you.
And then it just gets deducted out. Did you see that in the deductions, by the way? At the let me see if I have
Yes.
that.
Mhm.
Sales to other retailers. Okay. Good question.
Thank you, sir.
You betcha. Okay, compensating use tax. Well, we already talked about that. I'll just touch on it a little bit. So when you sell outside of the state, you may have to collect sales tax, which we talked about. But if you buy something from outside of the state that you're the end user of, so I'm not talking about inventory item. You can buy that outside of the state and not pay tax on it. And you might not even need an exemption certificate. Nowadays, I think you do. More and more, they're requiring that. But let's say you go to another state and buy tools, so something you're the end user of. So let's say you go to Colorado and you buy a computer for your business, and let's just say their rate is 7% and our rate is 8%. Well, now you'd owe the difference of 1% consumers compensating use tax. If their rate was 9% and ours was 8%, well, now you don't get a refund. You don't owe anything. You just keep the receipt because they collected their sales tax rate, their jurisdiction got paid, and since it was greater than ours, you don't owe any. Well, the law says that if you go outside of the state and you purchase something and you bring it back to our state and you use it, store it, or consume it, you haven't paid any sales tax or didn't pay an amount equal to or greater than our combined rate, you owe consumers compensating use tax. Exempt entities, their exemption covers direct purchases not only for sales tax, but for compensating use tax on direct purchases. The sales tax rate and the compensating use tax rate are exactly the same dollar for dollar in Kansas. There's no threshold in which it kicks in. It's the exact same. Some states do have thresholds, not us. It's exactly the same dollar for dollar. It's because we tax everything. Remember with sales tax, the gross receipts was the tax base. That's very important. It's the same thing with compensating use tax. It's the purchase price, the gross amount of the purchase price. So again, if they charged you shipping, it's just part of the price you paid. So just think of it exactly the same as the gross receipts. If we audit you for sales tax, we will automatically audit you for compensating use tax. It just happens. We have a lot of businesses that will first learn about compensating use tax when they're audited. That's the worst possible time to learn about it. And we've been accused of making that tax up. And now this has been around since 1937. So it's not a new tax at all. It was the imposition of this tax came around the exact same time as sales tax. Basically, they said, well, without it, those large purchases from another state, if they were delivered into Kansas, well, they wouldn't be able to, enforce the law for them to pay tax. So it's been around since 1937. Every state that has a sales tax has a form of use tax. It is a different tax, though. So again, this would be if you are making purchases you're the end user of, tools and equipment, that type of thing. Not your inventory, but tools and equipment outside of the state. If that's the case, you would need to register and get a consumer's compensating use tax number. So it'll be that number will be identical to your sales tax number, except it'll start with 006. Your sales tax number started with 004. The rest will be the same. So it is another return you have to file. I don't have that one on here, but it's an easier return, by the way. It's much easier, but it is a different return. The filing frequencies, the thresholds are the same, but it's going to be based on the individual tax. Meaning, let's say I'm a monthly filer with my sales tax, I'm in that threshold. But based on the amount I purchase for the compensating use tax, I'm an annual filer. So they don't automatically match up like that. They're based on the individual taxes. They have the same threshold, yeah, but they're based on the individual taxes. So I'm just letting you know. 2 different taxes, 2 different returns. So it's another thing you'll have to keep track of. And again, this would be something you're the end user of. You're buying outside of the state. So just to get it straight, sales tax, buyer and seller are both in the state. End user takes the combined rate of sales tax in effect where the end user takes delivery, the end. So that's the easiest one to remember. So that means, you know, wherever I took delivery of it, that's where I owe the tax. Wherever your customer takes delivery of it, that's where the rate you collect tax at. Compensating use tax, that's where it can be different. That's where the end user, so outside of the state, if their rate, you went there, and if you purchase something, if their rate is less than the rate over here in Kansas, at your location, your business location, then you would owe the difference. If their rate is the same or greater, then you don't owe any. Well, I already told you about economic nexus, about the Supreme Court case. I just didn't show you the pictures. Streamlined sales tax, I'll just hit on that real quick. If you are an online business going to be selling in multiple states, you might want to go to the Streamlined Sales Tax Act website. And it's called the Streamlined Sales Tax Act. But you go to their website and they have a list of all the member states. Kansas is a member state of the Streamlined Sales Tax Act. They update, tell you, they have the laws for every state. They also have, depending on if you qualify or not, they have these certified service providers. And what that is it's sort of like a software company that will, if you qualify for that for free, the state pays for that software and that service of filing your sales tax return for that state. To qualify, you must be a voluntary collector in that state. So to meet that status, you'll have to check with them. So you pretty much had to have not already registered in that state, not already sold in that state. There's other criteria as well. So you'll need to go to that website and check them out. But if you do qualify, then they will collect the sales tax in that state for you, you know, on your behalf. And they have a little different rules than in Kansas, which is kind of neat, meaning some of it is that they don't even have to file you don't have to file a return if you don't have any sales in some of those. Well, Kansas, you do. If you have even if you don't have a return, you have to file even if you don't have any sales, you have to file a return. So, so just check out if you think you're going to be selling in another state, you might want to check out that Streamlined Sales Tax Act. I just shoved a whole bunch of information into your head. And so I always tell everybody that it's a lot to digest here. If you have questions, you know, let me give you I'll put there, that's my direct phone number. That's my direct email. Now I'm the only one that does what I do. So I do a lot of these classes. So sometimes I might take me a couple days or a week to get back to you. With that said, it does not bother me and I'm happy to get back to you. So that's how you can get a hold of me.
Carl, we've got a compensating use tax question.
Okay.
We buy an item from an out-of-state vendor. They charge us their calculation of the Kansas tax. When we report that, is that on the use tax return? Or is
Is that for something you sell?
I don't know. I can't turn this mic on because they're anonymous. So
Oh, okay. Um, if they collect Kansas sales tax, you just keep the receipt because remote sellers are required to collect Kansas sales tax. So remote seller means they don't even have a location, but they're selling into Kansas. So if it's something you're the end user of, like a tool or equipment, if they're already collecting tax, just keep the receipt, make sure it, you can scan it, keep it as a PDF or make sure it's not that thermal paper or something. But if it's something you're the end user of, you can keep a copy of the receipt. You don't owe the sales tax, if it's the accurate rate.
okay, he's on the mic now. So go ahead, Ronald.
Oh,
Yeah, hello, Carl. Yeah, okay. So
Hi.
we buy an item from an out-of-state vendor. They ship it to us and they charge their estimate of the Kansas tax. Then we've got to, we file a compensating use tax return every month because we keep track of that. But their calculation of the tax rate is different than our calculation of the tax rate. On the compensating use tax return, the amount of tax that we've paid to them, does that go in the line item that says paid to out of state? Because really it's an in-state tax, it's not an out-of-state tax. So where do we report that on the compensating use tax return? So say they collected 5%, we've got to collect 7%. We got to pay the 2% difference. That's all we just need to pay the 2% difference because we already paid the 5%, right?
Yeah, I'd put it in the out of state, but is this something you're selling or something
No, this is something we bought. If we're selling, we wouldn't pay tax on it, right?
Right.
So
okay. I just want to make sure.
we're using it, right?
Yeah, and if I would try to contact them though, but I guess you're not gonna. You don't have to buy this over and over again though. I take it.
Yeah, like maybe once a year or once every 2 years.
Okay, well, I'd let them know. Hey, this is the rate we want you to collect. Make it easier for you, but yeah, just put it in the other state so that you get credit for it, and make a note in your books if you're ever audited. This is why we did that. It really goes in the.
There's not a spot for that on the compensating use tax return.
No, because it's really designed for, hey, I paid this much, and you could kind of look at it as, well, I went there and I paid that much. It makes me wonder, are they collecting the Kansas rate?
That's not my problem.
Because it's illegal for them to collect their states. Because if they're collecting 5%, there's nowhere in Kansas where it's 5%.
Well, but see, where we live, we pay more than just the Kansas sales tax.
Yeah, but even the Kansas rate's not 5%; it's 6.5%.
Okay, yeah, but I use 5% as an example. Okay, so they're charging some rate. We have one vendor that charges 3%. We have another vendor that charges 10%. So
yeah. So if anyone who's charging you less than 6.5% is charging you probably their state's sales tax, and it's illegal for them to do that. They're doing it wrong. Now, here's the first thing I should have told them.
I'm not going to go into. That's not my problem. That's their problem.
Well, it could be your problem. But,
not if I paid it and reported it. It's not my problem. It's their problem. Because I've paid it. I've reported it properly. I paid my difference in tax. That's not my problem. My job is not to police some vendor in some other state. That's not my problem. That's their tax problem or your problem, not my problem. I pay my tax.
Did you have another question?
No, that was it.
All right.
Yeah.
So I should have told you at the beginning, I don't turn anybody in, and by showing up doesn't flag you for an audit, because a lot of people get nervous and want to talk in code and stuff like that. So I should have said that. But are there any other questions?
Yeah, we've got one here, Carl, just a second. Buy the inventory for resale use one for a demo, then sell it at discount, or make a sample for advertising, and then sell the finished product. I don't. Rona, go ahead and ask. I messed that up. Go ahead and ask Carl your question.
Well, apparently, like I said, my typing and brain aren't connecting today. Okay, like on the first one, here I buy, well, I'm in quilting. Okay, so I buy a new style of ruler. I take one of them out of my inventory and use it for a demo so the customers can see and check it out, how it feels and stuff. And then after the new wears off, then we sell it at a discount. Okay, so at what point do I pay tax on that?
Well, if you sell it, you still wouldn't have to pay tax on it, so long as you sell it.
Okay.
If you don't end up selling it, though, let me put it this way: if you come there and you're using it, and an auditor says, "Well, you're using that," you need to report that. How long do you use it? Let's put it that way.
Oh, it's usually just like a month. You know, I mean, it's enough time for everybody to come in, check it out, play with it, and look at it and say, "Oh, I got to have this," you know. And then since it,
yeah, that shouldn't cause a tax. I mean, if you're using it for years, that I would say that'd be, a taxable event. But if you're just using it and then you're going to sell it, then that shouldn't be. You're still going to resell it then, so it should. You're still allowed to buy it without tax.
Okay. Now it'd be the similar thing with the next one. Is okay, we get the material in, a lot of customers like kits, but they want to see what the kit looks like. So the same scenario there, that when we were creating the kits, we'll take one and make it and put it together and hang it up to go with the kits as advertisement, then after, usually sometimes that might run maybe 2 or 3 months, but then after the new wears off of that, you sell the quilt and it goes out the door with whoever buys it.
Yeah, again, if you sell it, you won't owe tax on it.
Okay, no consumer tax. I still owe sales tax because they sold it. But,
right.
Okay. Well, that was my questions, because I was looking at, how do we earmark the merchandise?
Well, if they audit you, you have to do an inventory.
Right.
So you have to have an inventory. So it's either you sold it, or it's still for sale. What we do is they'll come with your federal return. A lot of times they'll piggyback on that, and a lot of time on the federal return you'll have an inventory there where maybe there's waste items, or maybe there's theft, or different things like that you're able to claim and deduct. You don't have that option on a sales tax return as far as deducting, but some of those things are not taxable. For example, like restaurants, when they're making salads and stuff, well, they don't use 100% of the lettuce. Well, any of the waste items, you deduct that, of course, on the federal return, but any waste is not deductible. If it was stolen, you're going to deduct that. Well, that's, not taxable either. So it's if you sell it. So if it's still for sale, no problem. You don't owe sales tax on it yet. So you're still have it for sale. So at some point, somebody can buy that. So you're okay.
Okay. The other question you just touched on was the theft too. We just have to track it and have it available that these items were.
You'll need that for not only for us, but for the IRS. So yeah, you'll definitely want to make sure and have a good inventory.
Okay.
But yeah, that's just part of the business there is keeping track of that stuff. And all it is making sure you're just accounting for it. It's either I still have it for sale, and for you, those are ingredient component parts. So I still have it for sale. There was theft, so there's a loss. So that's part of my loss category, or I sold it. So that could be there too.
Okay, got another one, Carl.
Okay.
We sell custom furniture. If the customer buys the raw material and then we build the furniture for them, do we collect tax on that, sales tax on that item?
Yes.
Labor.
Yes.
That was a quick answer.
That one's easy because that's tangible personal property. Because you're altering it. So remember, repair, service, alter, or maintain tangible. So they're bringing you tangible personal property and you're altering it. You're turning it into something.
So Carl, I just to kind of chime in here to get to a little bit more of the root of the question here. So this comes up a lot with people that provide labor services. When somebody brings you that wood or that material to put together, they've obviously already paid for it and paid sales tax on it. You're going to build it for them, and you may use some glue in this case, and you may put it together. But the end product, what you charge them for that labor or for that creation is what's going to be taxed, correct?
Correct. The labor to do that is taxable.
Gotcha. Okay. Thanks.
Yeah, that's one that it's hard to wrap your head around until you finally have to break it down and say, yeah, when you repair, service, alter, or maintain tangible personal property. Yeah, it's the same as that, that shirt I was talking about. You're just doing it to wood. You're taking that wood and turning it into something. You're altering it. Law said, well, okay, that's a taxable service.
Well, all right. Tom, did you have anything else to add for today or anything else?
Nope, I do not.
So, Carl, any last words from you or Carl York?
No, just if anyone has any questions, they feel free to email me or call me. I'm happy to help any way I can.
Yeah,
and thank you guys for spending some time with us.
The same goes for Tom and I today. Email us, and Carl's great about answering questions that we might filter through to him if needed. This presentation and recording will be available and sent out to you sometime within the next week or so for your review if you want to watch it again. Other than that, we appreciate your attendance today and hope you have a good week, and probably see a few of you next week on the contractor's tax. So everybody have a good day. Thanks for your attendance. Thank you, Carl. Great presentation.